This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Louis' picture saying, looking for the downloads. Now, Eric, let's jump into crude oil, starting with the EIA inventory.
EIA printed a drawdown of 3.7 million barrels, Cushing, Oklahoma building 500,000 barrels, gasoline building 1.3 million barrels, distillates building 0.9 million barrels for a net petroleum drawdown of 1.5 million barrels. U.S. production ticked up 100,000 barrels to 13.4 million barrels. I think that may be a new weekly record, at least in the weekly data series. What remains to be seen is, will it hold, and will we be able to sustain a trend even higher? We've been holding that 13.3 million barrel plateau for quite a few months now. This week's low on WTI was a perfect test of the 200-month moving average, which is at 71.74. For the moment, increasing recession fears and broad market weakness are driving crude back towards its December 23 lows, down around 67.77. We got a bounce on Wednesday, but we did not clear the 13-day moving average, so the trend has not really reversed yet. In my opinion, geopolitical risk is higher than the market is discounting, but absent any immediate threat, and by the time you guys hear this, it may have happened. Everybody keeps thinking that the big Iran-Israel thing is happening any minute now. Hasn't happened as of the moment I'm recording. We'll see what happens in the next few days. But until there is that immediate threat, we've got plenty of spare capacity and thus plenty of market complacency about supply. The term structure is still in solid structural backwardation, which is normally bullish, but the extent of that backwardation is diminishing rapidly, and the trend is more important than the absolute number being in backwardation or contango. If Louis is right about the bear market and recession call that he made in the feature interview, there's plenty of room to trade lower on oil until the geopolitical risks resurface, which I think is coming and probably coming soon.
Well, Eric, I get it that crude oil generally can weaken going into a potential economic recession. It certainly is trading at the bottom end of its trade ranges. I think that on the very short term, these support lines can offer a reaction. A reaction is not a new bull phase, but simply offer several dollars on the upside from a very oversold state. And while during the first impulses, I could see the view that crude oil could still make a little bit of a lower low and push there. The one thing that I've observed in the past, though, is that often these commodities will sell off going into a recession, but then bottom and even reverse during the actual recession. So even though the recession call is an entirely plausible scenario, it's probably too early to buy crude. It probably may still go a little bit lower, but I'm not as bearish about the downside in terms of how low it's going to go further from here. Nonetheless, let's move on to equities. And Eric, I know you have some thoughts here. What's on your mind?
Well, my first observation is I'm concerned that we have a new generation of traders who thought this small correction was a crash. There's even a T-shirt saying you survived the crash of August of 24. Folks, this was not a crash. And the fact that everyone thought it was a crash, or a lot of people thought it was a crash, tells me that the marketplace is not ready to deal with a real crash, and that makes one more likely. The Bank of Japan's capitulation came after we taped Louis Gav's interview, so he wasn't aware of that news when we spoke. Election year politics could influence monetary policy and shock markets in either direction from here. So I'm not quite as confident as Louis is in terms of his bear market call. I think it made perfect sense, but I also see plenty of opportunity for interventions to occur in this election season that could take the market in either direction. As I've said before, I think election-related risks are underpriced in the market. Look at what just happened over over a BOJ rate hike and a jobs report. Now, sure, you can argue that those things were just catalysts and the market was set for a correction anyway, but look at what a big event we just had in the market over relatively small catalysts. Now imagine a much larger event. We've got this Raskin guy threatening to have Congress ban Trump even after he's elected. If that happens, we've always got the risk of further upsets in this election process. There's plenty of things that could be bigger catalysts for a market event than a jobs report or a policy error by the BOJ unwinding the carry trade. And I don't think that those risks have been correctly priced by the market. Look how quickly the UK's unrest has escalated over these migrant knife attacks. I think that big things could happen in this election season, and they will affect markets. Bottom line, there's a huge uncertainty for the next 5.5 months until Inauguration Day, not just Election Day. Short term, the biggest question in my mind is whether the bounce that we're seeing in reaction to the BOJ's capitulation on Wednesday will lead to a meaningful rally or just a dead cat bounce. My vote, at least on the data I've seen so far, is definitely in the dead cat bounce category. First, we saw before the BOJ's capitulation, right after that big sell-off, there was a little bit of a relief rally right up to the 100-day moving average. It failed and failed badly at that 100-day, rejected strong to the downside, closed almost back down to the lows of the day. Then we had the BOJ event. We rallied on that right back up again to the 100-day moving average, which was the key support previously. Now it's acting as resistance. Couldn't get above it, and again, sharply corrected back down. These things say to me that we probably have not ground down to the final low yet in this sell-off before we get a meaningful relief rally. Once we do get that meaningful relief rally, maybe it's down to the 200-day, which is not that far below down. It looks like 5060 or so is the 200-day. Maybe that's what we see next, and then we get a relief rally. Do you short or hedge on the top of that relief rally because you think we're in a new bear market, as Louis has suggested, or is it all over? I'm kind of leaning towards Louis's call of the bear market, but anything can happen in this news flow.
All right, I want to get Nick involved in this conversation. Now, Nick, the S&P 500 volatility has been taken up a notch here. First of all, let's just talk about your levels and what are your thoughts here on the S&P?
Yeah, Patrick. So right now the spot price on SPX is approximately 5,200, and we have an implied move for next Friday's monthly OPEX of plus minus 150 points. Therefore, the upper implied move is 5,350, and the lower implied move is 5,050. Right now, we have key resistance at 5,350, and we have key support at 5,100. I'm inclined to think we see a bit of a kangaroo market the next few weeks as the VIX is really spiked up, and we're looking at ranges each day from top to bottom of over 100 points. So we're seeing a lot of these pops then drops or drops then pops. And I think that will continue until next Friday's monthly OPEX at minimum.
Yeah, that's an interesting perspective there. I agree with that. First of all, the implied daily ranges is the part that's very hard for a lot of people to kind of absorb, which is the fact that 100-point swing higher or lower is often meaningless to the primary trend, and it's just normal daily volatility. I think that overall, on the very short term, we are very oversold. And while I actually think the window is open for a quick drop down to even the 5,000 level on the S&P, I actually think that the tactical opportunity to be short on this in the month of August here is come and gone. Now, you could clip a quick swing trade on this, but I think that we're going to probably put in a swing low that will end up later in August seeing a retrace easily back to 5,400. Anyone who's trying to put on brand new shorts here is going to have their resolve tested during some sort of retrace. Now, in the bigger picture, it is very likely in my mind that the high of the year is in. And when we go back to an analog like 2007, when that July 2007 market drop occurred, the high was still retested in October. And so even though I think that the high of the year is very likely in, what is not clear is whether or not this is some sort of a straight line move down into a deeper correction. Odds are actually quite reasonable that it's going to be a meat grinder here for the next couple of months that is going to test all the shorts and the longs in both directions. It's better to just trade smaller sizing and be tactical about those entries and exits. I want to move on, though, to just touching on the Russell chart here, Nick, on page 4. And what we had was a very clear pop and drop. And one of my convictions was that whether the Russell outperforms on a relative basis, that it was likely not going to have a negative correlation where it was going to be rallying when the rest of the market's selling. And that clearly became the case here, where simply the weight of the whole market declining dragged the Russell right back down. It's now trading right back into the trade ranges that are established throughout the year. And I don't think I have a strong conviction here. I think it's neither going to be really bullish, nor do I think that this is where one should be bearish. I think it's just going to end up being a place where I'm not going to spend a lot of time watching. Do you have a different conviction on the small caps?
Yeah, right now I'm staying long on the small caps only because I'm short mega tech right now. So right now it's kind of a nice pair trade. As we see the market decline, typically the large caps tend to underperform the broad market and small caps fall less than those large caps. So right now I'm long via butterflies on Russell. So, asymmetry of risk is pretty strong. If I'm incorrect, not a big deal, but more so that it's a pair trade with the Nasdaq right now.
So on page 5, I wanted to squeeze in a chart on the Nikkei because this really was where all the action happened. We'll talk about the yen in a moment, but the Nikkei had a peak to trough 25+% decline. That was truly the kind of like 1987 style crash that happened, but it happened in Japan and was an unwind of that carry trade. What we can see is that the Nikkei already bounced, and I do believe that on the short term, that low is going to be a low that's going to hold for months on the Nikkei. And I think that until the bear market develops another theme somewhere else where something else is breaking, the fact that the Nikkei is probably put in its low is going to also generally put in the low in most risk assets, at least on the short term. And so the Nikkei, I think, could work its way back to 37,000 during this bounce, and watching vulnerability as to when the Nikkei starts to sell again later this year will actually, I think, be an important tell on global risk assets. Moving on to page 6, we have the chart of the Nasdaq, and this is where much of the aggressive selling was, as the AI stocks were a focal point during much of the selling. What are the levels you're watching here, Nick?
Yeah, so right now the Qs are at a spot price of approximately 440, and we have an implied move for next Friday's monthly OPEX of plus minus 15 points, which is pretty large considering it's only about a week time frame. Right now the implied move to the upside is 455, and the lower implied move is 425. We have key resistance right now at 565 and key support at around 415. As I mentioned previously, I would be very cautious with mega caps right now, as I do think that they have potential to either, if not fall further, at least not bounce too much in the short term. We've seen names like Nvidia, for example, sell off. However, they have earnings in a couple of weeks. That could be a catalyst to the upside if they do outperform again and kind of surprise to the upside on EPS and revs as well as guidance. There are some names that, in my opinion, make sense to own, like Palantir and Shopify, for example. They've been outperforming overall. They have great earnings as well. Shopify had a phenomenal report yesterday, and I'm long Shopify right now. But overall, the broad tech sector to me doesn't look investable in the short term.
On page 7 here, Nick, we got the volatility index that Nikkei and carry trade unwind had a whole series of traders grabbing at risk premium, and essentially the VIX puked with a move north of 60 on the upside. We haven't seen that since the COVID crash. Obviously, it's mean reverted quite a bit since then, but what a move. How do you size this up?
Yeah, Patrick. So with the VIX right now at about a 28 handle, we expect to see top to bottom ranges in SPX of about 1.62% or so. From last Thursday's close on the S&P to Monday's decline, the S&P declined by 8% in just 2 trading days, which is pretty insane overall. So seeing this kind of action, come out of nowhere is, pretty surprising overall. but I've been saying the past few weeks that buying insurance when it's cheap makes a lot of sense. You don't want to be buying flood insurance during a hurricane. You want to be buying it when it's dry outside, right? But over the last few weeks, we've seen the VIX ramp up a little bit. And I think that's in large part due to the election approaching and so much uncertainty around that event. So right now, I think that it's important to look at your portfolios and understand that insurance right now is very expensive. So hedging isn't very wise. And as Patrick previously said, downside may be limited in the short term, but as the VIX gets lower again, and in the future, when we see the VIX that low, it makes a lot of sense to look at buying insurance on your portfolio, assuming it correlates heavily to the S&P. Now, moving on, Eric, let's talk about the US dollar. What are your thoughts here?
Louis' call that we may be entering a new U.S. dollar bear market is absolutely essential to understand and monitor. If he's proven right, it's a major opportunity to be long the right strategic commodities. I say uranium, copper, and crude oil will be the big winners if Louis' dollar call proves right.
Well, Eric, the dollar has been in bigger context in a big meat grinder against all the different cross currencies. So really on page 8, I just want to talk specifically about the one that is genuinely trending, and that's the U.S. dollar yen, as the yen carry trade just blew up. I mean, we had a 2,000 pip move on the U.S. dollar yen in a span of less than a month. Just an incredible move. But the thing is that at this stage, it's so incredibly oversold that I think that this precipitating driver of market volatility is likely to have a pause. Now, I think that the low of the yen and the high of the dollar is definitively in. The idea that that somehow the U.S. dollar yen is going to go and retest 162 is very unlikely. But could we have a bounce back towards 150 on the upside during a period where the market just kind of absorbs this extraordinary move? I think so. And that could be the driver of calming the markets right down for the remainder of the summer. And so this is why thematically, in general, I think that while we have seen a lot of volatility and likely a bear market has begun and likely the highs of the market are in, but I also think that the next couple weeks or even a month or more is going to be a lot of absorbing and backfilling of this first initial move, and that a lot of the real volatility and crazy things is probably going to be pushed towards the fourth quarter of the year.
Now, moving on to page 9, we have that gold futures chart. What are you guys thinking here?
Everything going on right now is fundamentally bullish for gold. But as Louis said in the feature interview, if we get an actual market crash, the only thing that goes up is correlations. Gold will be dragged down with everything else. It'll then bottom before everything else, and that will be the buying opportunity of the decade. Trying to time that is probably a fool's errand. I'm not selling anything here. I'm holding my longs, and I hope I'm smart enough to know when to add to them if I can time the bottom. But I'm not going to take anything off the table because a geopolitical escalation could come at any moment to send gold dramatically higher.
Technically, gold is in a bull trend. Higher highs, higher lows, holding above its moving averages. The trend lines are holding along the upside. So technically, there isn't anything negative to say about gold. The bigger question I always think about here is this the macro backdrop from which gold is ready to make a move to 2,700 on the upside? I've been generally quite bullish gold, but I think that at this stage, during the initial violence of this market volatility, I think that there could be numerous fake outs. Overall, if there is any short-term liquidity event that causes gold to lose $100 or $200 an ounce, I think it would be an extraordinary buying opportunity on dip. I'm not predicting that will happen, but in these kind of market conditions, if there's broader liquidity issues, gold tends to be volatile with all risk assets. So it's one of these scenarios where, big picture, I remain quite bullish. Technically, there's no reason to be concerned, but the conditions in the broader macro markets is certainly just something that makes me want to make sure I remain structurally hedged on it. What I love to do with gold is wrap those collars around it because of the nature of the skew, and I think that just trying to reduce gold volatility through collars is a tactical way to make sure you have the staying power to stick with the trade.
Now, moving on to page 10, we have that uranium chart. Eric, what are your thoughts here?
Uranium mining shares were utterly slaughtered Friday and then slaughtered again even worse on Monday. And all of this was easy to see coming. We predicted it here on MacroVoices several times, saying that if we saw a broader market sell-off, despite the fact that we really had a strong buy signal on uranium, if you analyze it in isolation, we also said that if there's a broader market dislocation, uranium's going to get wiped out with it because of all of the retail participation. I also suggested the safety trade there was out of the mining shares and into SPUT, and that proved prescient. SPUT's actually been up in the last couple of days and is pretty much held its ground since its low last week, whereas the mining shares predictably have moved much lower. So to be clear, uranium is a strong buy here, as it has been for weeks by any measure, as are the uranium mining shares. But as both I and our friends over at uraniuminsider.com have warned, this is a famously volatile sector, and a broad market crash could easily cause a washout. Now, if that happens, it's a generational opportunity to load up on uranium and uranium miners. It's already a fantastic opportunity. It might get better. The fundamentals are not going to change, and the fundamentals will win in the end. But that doesn't mean that we're not going to have a wild ride before we get there. And there's a lot of retail participation and weak hands that are going to be wiped out if these guys get margin called, which is probably what's about to happen. In reaction to this market volatility, our friends at Uranium Insider moved their monthly webinar up to yesterday to address this market weakness. These guys are real pros and doing a fantastic job. I cannot comment in detail out of respect for their other paying subscribers, but the gist of it is pretty much what I've already said. Uranium and miners are way oversold. It's a fantastic buying opportunity, but that doesn't mean the buying opportunity isn't going to get even better if this broader market sell-off continues in the broader stock market. SPUT traded at a 16% discount to NAV this week. That is absolutely amazing. It's only a couple of times before that's happened, and it usually has marked market bottoms. Think about that. The spot price of uranium is already just a couple of dollars over the long-term contracting price. If you can buy it for 16% discount, just as a function of SPUT being a closed-end fund that can trade at a discount to its NAV, that means you're buying it below the long-term contracting price. You've also got a sub-30 RSI, which has always been a very reliable buy signal in the past. There's a whole bunch of other charts and graphs and fundamentals. The essence of it is the Uranium Insider guys are saying essentially the same thing I am, which is there's a zillion reasons. They go into much more detail than I do for why this is an absolutely strong buy right now, with the strong caveat that that doesn't mean it can't go down farther from here, especially if we get a broad market crash. I've tried to figure out an efficient way to hedge this. I can't find that. I don't think there is an efficient hedge that you could have carried unless you magically knew exactly how to time this. And it's not easy if you're trading in any size at all to unwind large positions in these illiquid uranium mining shares. So I don't see a really strong hedging strategy. You've got to be willing to tolerate the volatility of this market. If you can't, it means your position size is too high. People keep hitting me up for symbols. First of all, look, Uranium Insider is dirt cheap as a newsletter subscription. They do a fantastic job. They're going to give you better advice than I can. But I'll give you some highlights. The safe trade here is to buy the uranium itself as opposed to the mining shares. It's going to have less upside ultimately, but I don't think it has nearly as much downside risk right now if the broader stock market goes down. If it does go markedly below its NAV, you're still buying, you're buying a commodity at a discount to its price. Yellow Cake, which is, and I should mention SPUT, this ticker for that is U.UN. Yellow Cake, which is traded on the London Stock Exchange, has traded at an even deeper discount to NAV. That's YCA, Yankee Charlie Alpha, on the LSE. If you're set up to trade the LSE in British pounds, great. Otherwise, I'd stay away from that one just because, although it is a deeper discount to NAV, it doesn't seem to track back up to NAV. In other words, when I see SPUT get to more than a 10% discount to NAV, you buy it, and it's not too long before you get a chance to sell it at NAV. I don't see YCA returning to NAV as easily. So I still prefer SPUT over YCA for buying uranium itself. Moving down from there in terms of a little more volatility and a little more upside, Cameco is the blue chip IBM of nuclear, if you will. They own half of Westinghouse. They're one of the biggest uranium producers. They're also a very large stakeholder in global laser enrichment, which is the laser enrichment technology instead of centrifuges. Just big company, but a staple, trading at a huge discount to where it's traded recently. So we get into a little more risk. The producing uranium miners, and just in terms of which ones look like the best bargains to me because they're oversold to a ridiculous extent, I would say Next Gen Energy, that's NXE, and Encore, EU. Would be my favorites in terms of big producers. Getting into the higher risk, higher speculative opportunity category, we've talked about Global Atomic before. That's the company that has the Dasa mine in Niger. I think that mine is definitely going to be very important. The thing is, at this point, Global's banking syndicate appears to be walking away from the deal. I think they are going to build their mine. I think it is going to be very important. Unfortunately for me and the other prior shareholders, I think it's going to be a much more dilutive transaction to get the funding that they need than we had hoped for. I don't think they're going to get bank financing. They're probably going to have to do another equity raise, and we're going to be diluted. So I'm not rushing to put anything more into that one. For the speculative trades, I would say the biggest sell-offs have been in Lotus Resources. That trades on the Australian Stock Exchange on ticker LOT. I think the fact that it's on the ASX, where a lot of people don't have access to it, might be the reason that it's sold off harder than a lot of its peers have. I think it's an excellent company. And finally, if you want a much more speculative and therefore risky pure exploration trade, in other words, they don't actually produce uranium, they find uranium and get ready to build the mine later, that would be F3 Uranium, ticker FUU on the TSX Venture, I believe. So those are some symbols. If you want better symbols and better analysis, frankly, subscribe to Uranium Insider. That's what I do.
Eric, you're bang on. 16% discount to NAV. Like the Sprott Physical is taking some abuse on a relative basis to where spot uranium prices are. Overall, the bull story for uranium is there, but the thing is that when will investors care? At this stage, this has been distributing all year, and I don't know if under this backdrop is when new money flow is coming in here. I overall think that this is a great long-term investment, but we're going to watch for technical signals when short-term lows really start to establish themselves and potential new bull trends start. But I think it's going to be a process here and patiently waiting. We'll observe, obviously, technically when things start to turn here. It really hasn't shown any sign of life just yet. Finally, guys, I want to just touch on the yields. Now, first off, I want to touch on the 10-year Treasury yield, which is essentially, as this market had shit hit the fan, you had a scenario where yields collapsed, bonds were a safe haven. That was thematically something that we touched upon in the show numerous times. I still think that that's going to be the case for the remainder of the year. I'm not super bullish on bonds that I think we're going back on the 10 and 30-year bonds to like 2% yields or something. But generally, I feel that the bear market of bonds that was the theme through 2022 and 23 is over, and bonds will perform a safe haven element throughout this leg of the bear market, and the yield is going to be something that investors are going to be grabbing at. Generally, shorter duration makes a lot of sense here, like going to 2s and 5s, but overall, the 10-year has been in this very clear bull trend here, and I don't think it's going to stop. Maybe pauses here for a month because of just the conditions of the market are so oversold, but I think old dips should be bought on treasuries tactically for the next few months ahead. ahead. Now, the last thing is on page 12, I have the 2s10s yield curve, which for the first time has approached the 0% after being negative for almost a year and a half, almost 2 years. And I think it's a pretty big deal. Generally, the bull steepener is going to kick in largely because, central banks are cutting, and that's going to impact a 2-year on a relative basis. And this is typically a recession signal. It has in the past. A lot of people in the soft or landing, no landing camp were skeptical of it, but I actually don't want to ignore this signal. Obviously, Powell has already very clearly advertised that we are going to be in a rate cut cycle that usually will cause the 2-year to move in a bull steepening, and that does drive the trend higher on this. So it's definitely a breakout, and I wouldn't be shocked if we get back into positive territory and stay there on this yield curve.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.